Hi everyone, welcome to this live event. As usual, I'm here to share with you the market and what we could expect from mayors this week, right? And of course, the main event are central banks as usual, starting with the Fed tomorrow, right? And the Bank of Japan on Friday. It's really impressive how much attention central banks are gathering these days. In spite they're doing pretty much nothing but talk. Anyway, let's take a look at the fundamental calendar and see what we could expect for the upcoming days. As you can see for today, there has been no data in Europe, but there are a number of several interesting readings coming out in the US. The service PMI and the composite one, expected slightly higher, the service one, consumer confidence, new home sales, and the Fed manufacturing index. I would say that all in one, if these reports are better than expected and in line with what we have been seeing lately coming from the US, chances are that the dollar will resume its advance, particularly against its European rivals, which seem to be the most weaker, right? The yen is doing another completely different things, while commodity-related currencies seems to be stronger today due to risk aversion and gold recovering ground. Anyway, that's a different chapter. Commodity currencies are in one hand and European ones are in the other. Anyway, as I was saying, this positive data, if this data is positive, right, the market will be further considering the possibility of having a hawkish Fed tomorrow. The fact is that, as I said plenty of times over the past few coverages, US data has been quite positive during the second quarter and at the beginning of the third quarter, right? Spooking away the ghost of an economic slowdown we have seen late 2015, early this year. And despite, we are expecting the Fed to remain on hold probably until middle next year or even longer. This positive data is putting some pressure on the Fed to act sooner than expected. To be honest, at this point, I don't see the Fed raising rates again this year. It's quite unlikely, right? If we have a live meeting in September, but we are too close to elections in the US, and I could say that Yellen will prefer to wait and see what happens with elections before taking such a huge decision. And then we have just December for another rate hike, and seems pretty unlikely with the current environment. Consider the fact that there's practically no economy, not major economy, not easing, right? The ECB did not do much, but left doors open for easing. The Bank of Japan is expected to ease on Friday. The Bank of England, no doubts, will ease in August. The Australian Central Bank has cut rates a couple of months ago, and we have tonight, during the upcoming Asian session, the trim inflation in Australia, and if that comes below expected, will probably mean the Australia will also cut rates, right? So in such environment, it's hard for the US to rise rates and strengthen its currency, right? That would probably already be strong enough after those mayors, central banks act. Anyway, at least what we are expecting for tomorrow is quite a hawkish stance, right, coming from the Fed. And that, of course, will be dollar strength. Anyway, as I was saying, at the beginning of Wednesday, early Asia, Australia will release its second quarter inflation figures. The fact is that in the previous quarter, there was a sharp decline in inflation, and that was behind the Reserve Bank of Australia rate cut. So pretty much if we had anything below this 1.5, the market would run to price in another rate cut in Australia, and therefore the Aussie will probably fall with the news, okay? There are several minor figures coming from Europe and the euro area tomorrow, but I don't think that import prices or the consumer confidence survey in Germany will be enough to move the euro, right? In the UK, we have GDP figures. It's a preliminary reading from the second quarter. Consider that most of the information gathered in for this particular GDP figure It's previous to the Brexit. We know that local business had become pretty cautious in June. Data coming from the last month and this month is showing that everyone was in wait and see mode. Investment has declined, sales declined in late June. So there's a good chance that this expected zero point 0.5 against previous zero point 0.4 will be a miss, right? There's a good chance GDP will be a miss. But I don't expect that to be a shock to the market. Anyway, it will wait further on the pound. We will talk about technical levels in a few. Just give me a few, okay, a few minutes. And for the US durable goods orders, they have been already revised higher, lower, sorry, revised lower ahead of the release for this Wednesday. To be honest, this is a good market mover. This is among the most relevant data the US release, or the one that gives more sense to a dollar trend once released. We are expecting it to come slightly better than in May, but still not good enough. If we have a positive number in year, or something above this 0.3 in year, I would expect a strong dollar rally. To be honest, this is quite relevant report. On Thursday, again, a lot of minor data coming from Europe, consumer confidence, inflation in Germany. Uh, Again, I don't think how this data can support the euro. And on the other hand, I believe that if it's disappointing, it will probably weigh on the common currency, you know. And I do believe that not much, not really, nothing really relevant in the US, but I will be paying attention to inflation in Japan because it's going to be released a couple of hours before the Bank of England, the Bank of Japan meeting, right? So if we had really bad numbers in inflation in here, and the Bank of Japan decides to act or not, or if that is good and the Bank of Japan does not act, and in any case, it will be a huge move for Japanese yen crosses. Speaking of which, we are going to see what happened today. Uh, anyway, on Friday, I do believe that most of the attention will be focusing in European GDP, right? The numbers are expected slightly below previous ones. Uh, I, I believe that we're going to get even worse numbers because of the Brexit, right? Brexit has been quite a problem, and will probably uh, be reflected in the GDP from the second quarter and on. Anyway, the third quarter will be even worse after this July developments in the market in August. I do believe that we are going to get big miss in the third quarter GDP, but this will tell us where the GDP is going, and we'll probably get a miss, putting further pressure over European currencies. For the US, we have the preliminary reading of the second quarter GDP, and this is quite. It's also a big market mover. You know, it's the first release uh, of U.S. Gross domestic product, and it's expected quite strong. To be honest, 1.8 quarterly against 0.4 through price index at 2% GDP. 2.6% growth in the second quarter GDP against previous 1.1 final. If that's the case, put your bets on the greenback, you know. Anyway, give me a second. I will change to charts. I'm having my morning coffee. Here we go. To be honest, there's little going on in the market beyond dollar to exchange today. The fact is that the market has rushed to price in a lot of easy coming from the government of Japan, fiscal and monetary, right? And that's why we had that rally up to 106 750 last week, which, take a look at the daily, it started right around a bearish 100 simple moving average. All of a sudden, and given that Finance Minister Terawasu said last night that uh, he he believes that the Bank of Japan will do whatever it takes, sort of. That's not where I heard his exact words, but that's what he said. Arise concerns that the government is not really sure of what they're going to do next, and the meeting is in 2 days, right? Yes, I have discussed this previously in coverage and in reports. The market price in a lot of action, and the Bank of Japan has a tendency to disappoint, right? Not to act firmly. And right now, the market is taking notice of that, of the possibility that we don't have the massive stimulus the market has believed initially, and that's why the pair plummet. I believe that it's also about taking profits out of the table, what we have seen after the pair refused to break above that moving average. So we are having right now fundamentals and technicals going in the same way. Of course, the pair has shed over 160, 70 pips already today, so not expecting much action from here on, particularly with the Fed tomorrow, but still, the risk has turned towards downside right now. Okay, for the day, for the intraday, for the coming hours, the daily low has been 104, which is also, take a look at the 1 and 200 moving average in the 4-hour charts. Maybe not as relevant as in the 1 hour or in the daily, but still they are there. I do believe that if we take 104, the pair can keep on falling down to this previous high, right, in the 103.40 region, but not much more for today. And the most likely scenario is that if stocks today are quiet in the US, which seems unlikely, uh, the pair will probably range. Anyway, this is the probable top for today. Bottom for today. Honestly, 100 more pips from current level seems a bit too much after what we already had. If the Bank of Japan triggers massive easing, right, massive easing later in the week, we can go back up to these highs. But if it does not, I do see the pair plummeting towards the 100, 150 region by the end of the week. Okay, and the immediate resistance right now, in the short term, of course, is the 100 460 region for the 105, 100 510. That's the most the pair can go. Should the dollar regain its shine over the upcoming hours? Okay, for the euro dollar, the fact is that there's so little going on in here, so little. Weekly basis, we have been trading within range for over 3 weeks until past one, sorry, when the pair ended at the lower end of that range. So far this week, we are seeing really limited price action. The pair seems to be meeting some selling interest around 110.50, which has been its comfort zone for most of the past 3 weeks, right? But it's quite sad what we are seeing in here. Not much price action, and pretty much after the Brexit, the pair has been choppy and directionless, with inclination to break lower, right? And we have this low around 950. I do believe that the key is the 910 level, which is the post-Brexit low. If we take that low, then I do see the pair plummeting further. Let me change to the weekly chart. I do believe that we mentioned this level before, 800, 840. If you draw a zone in that area, you will see in your daily that the pair has bottomed, bounced at top, at close plenty of times around that level, becoming a major static support level. Okay, so 800, 840 seems a probable bearish target in the case of further dollar strength and, of course, euro weakness. And at this point, I can't honestly see the pair breaking below it, but if it does, 460, right, and 500 are two major lows, monthly lows. So that's the next probable bearish target, the 460 500 region. if we take 800, of course. Seems a bit too long term for me, but anyway, those are the levels I'm thinking of these days in the year, right? And if you take in the 4-hour charts, take a look at the momentum indicator. It has been hovering around the 100 level back and forth. No certain directional strength, no nothing. No, let's remember that it's summer in the north hemisphere, guys, and we have really low volumes, and we have central banks, and we have uncertainty coming from England, and we have more easing coming from Japan, massive stimulus promised a couple of weeks ago. So with low volumes and high uncertainty, the fact is that the market is not willing to go anywhere during this month, and I dare to say that it will take a couple of more weeks to see real action in the market, right? But in the meantime, the euro is offering not much. I would say that intraday spikes are probably selling opportunities. 1150.60 is immediate intraday resistance. 110.90, 111 comes next, and of course, the line in the sign is 111.90, right? We have the post-Brexit high, and this one at 86, pretty much 4 pips. So that's the level to beat to talk about a bullish euro. In the meantime, I would say that not much there going on. And the same goes for the pound, right? The range has been drinking. If this week we have non-price action here, but what I'm making of this 4-hour chart is that the upside seems well limited. Sorry, as approaches to the 20 simple moving average have been triggering retracements. Right, it's maybe not relevant, but this candles after this big one. But we're talking about 50, 100 pips in the middle, so um, it's quite interesting. Still, I do see that dips towards the 130 region are so far attracting buying interest. As I said, I'm not seeing the pound going anywhere between these lows in 28 and this Fibonacci retracement around 133, at least until August, nowhere until the August Bank of England meeting, right? In fact, I do believe the range to be even tighter, 130, 132.20, right? For the until then. So those 150 pips, 250 pips, sorry, are the most the pair can move during the upcoming month. If somehow we take back this low 30.55, it was, I do believe that the pair can approach to 130, but I was saying I do believe that the level will attract some my interest. Okay, and we already talked about the relative exchange. So let's take a look at my next favorite pair, which is the Aussie. Okay, here we are after the rate cut and all of the market uncertainty. We are back in an upward trend, right? Not as strong as it has been earlier in the year, but I do still believe that the Aussie is among the strongest currency across the board. This latest retracement has found support in a major support, the 38.2% retracement of this year's early rally, and we are back in the bullish track. Of course, further gains in the year will depend on today's inflation numbers. If the Prime CPI beats expectations, okay, I could expect the pair to jump up to 76 during the upcoming Asian session, and even higher, right? Then, if inflation is really good, which we have minimum chances, the pair can go back up to 78.20, 78.30 or so. But in the meantime, this major support still holds, and as long as above it, I do believe that there's a bullish strength prevailing. And considering that even if the Australia cuts rates again, let's think about Australia cutting rates again. Rates are currently at 175, right? If they cut what 25, we are going to go to 120, 150, right? Let's consider that they cut even 50 basic points, we will be at 1.25%, right? Where are the rest of the economies? Negative rates, 0.5 floating, negative rates, meaning 0.5 also in the UK, negative in Europe, negative in Japan. I mean, it's still worth buying the Aussie, right? Still worth it. So after any initial noise we may have during the upcoming days, with the market rushing in to price in a probable upcoming rate cut in Australia, the pair will probably resume its advance. The Aussie will probably resume its gains against all of its major rivals. So beware of that. Beware of finding a nice support to buy against rather than thinking of breaking lower and falling. I would dare to say that there's no much chances of a downward continuation unless we break below the 71.50 and seems way too far away right now. Okay. Anyway, as I was saying, generally bullish approaches to the 74.50 area could be seen as a buying opportunity. Of course, today's it's a huge event, and if somehow the pair breaks below it, I would dare to say that we are going to go down to 73, 70, 74, and there would probably be the level that the market will decide to resume buying. Okay, oil, it's another big issue. We are developing in a round bottom. I was thinking that this 40 to 50 level, current level, would be a base, guys. I was thinking that this to be in a line in the sun, and there were limited chances of a break below it. But now I do believe that we are going to see further weakness in oil prices. Uh, there are many reasons to support the case. One is that oil derivatives product stocks have been rising immensely in the US. And the other reason is that oil rig counts, drilling rigs in the US have been rising. We have so far controlled terrorists in Nigeria, wildfires in Canada. So the market is again fearing of a global glut, right? So the risk has turned back towards downside, and in fact, we are breaking through these April daily lows, which are quite relevant. So there's a good chance that the commodity will continue its slide down to the 40 region during the upcoming days. We have the APA report tonight, the AIA report. So if we have stocks plummeting with in the US, maybe the commodity may recover growth, but if not, 140 seems a probable bearish target. To the upside now, the top would be this 44.40 region where we have plenty of daily highs and lows with a recovery above it, opening the doors for a steeper correction, higher up to 50, yet not that much. And finally, gold prices have so far corrected and entered a consolidative stage between Fibonacci levels. Not much to say in here today. Gold depends on the Fed, and if they're dovish or hawkish, a hawkish Fed will probably wait at prices. So I will be looking for a break below 1308 tomorrow to think about as the deeper downward corrective movement, probably down to 1285 or so, right? I'm not seeing much of a downward potential in here, to be honest. I do believe that we can see a break down to that level, even down to 1250 over the upcoming days. But the market will be seeking for safety. The uncertainty is too high still, and I don't expect gold to break, I don't know, to below 12 for 1250 right now. Okay. Anyway, sorry. Here we are. Let me move over the charts. Uh, Pretty much that's it for today. I will be covering live the Fed tomorrow with Ohio Mauricio, and on Friday will be the US GDP. So hope to see you then and there. Okay. Thank you and bye bye. See you soon.